to another video from Q3of4 Solutions. You're currently watching the support videos for the British International Distance College Accounting module. If you have any questions or comments, you can find our contact details on the website and consider following us on Instagram and Twitter, and keep watching the YouTube channel for more support. Currently, we're busy going through assignment questions, so you'll be able to answer those questions yourselves. To start with a third-party disclaimer, the last point I want to highlight, Q3of4 Solutions is a private institution and is by no way connected to the British International Distance College. Any reference made to the subject material refer to official BIDC material, and we do not represent them as our own. We simply work through the BIDC material with students as a means of additional academic support. I hope you found these videos helpful. We're currently busy with question number 3. Accounting is a very practical subject, so the more questions you can do, the better and easier it gets. So let's begin. We're looking at question 3 of assignment 3 from the assignment pack. Question 3 has A, B, C, D, and they've asked you to name one accounting concept which is being observed when a provision for doubtful debts is maintained. Then B, explain the difference between bad debts and provision. Okay, so these are all theory questions. Let's start with the first one. Question 3A. They say, name one accounting concept which is being observed when a provision for doubtful debts is maintained. Okay, let's first remember what a provision for doubtful debts is. If I've got a provision for doubtful debts, it means I'm providing for something now that relates to the future. So we need to describe what bad debt is. Bad debt is when customers who have bought on credit don't pay the business back. And from the business's point of view, that's bad. So bad debt or credit losses would be viewed as an expense. Obviously, a business is going to be operating, and year on year on year on year, the business will have a pretty good idea of a percentage of their debtors that aren't going to pay based on past experience. So when focusing on an accounting concept, you could talk about prudence again here. It was in question 2 as well. If you have gone through the previous video, you would have seen the last question in question 2 was asking about the concept of prudence. So this is something that you could also talk about here in terms of prudence. So what am I meaning by that? It's you're providing for a future expectation of bad debt arising from the existing debtors. So remember, debtors is an asset, so you're going to record your debtors in the statement of financial position. In the statement of financial position, so non-current assets, current assets actually, in the statement of financial position, you are going to be showing under current assets a line item called debtors. And in brackets, you're going to have your total debtors less the provision for doubtful debts. Because we know from past experience that not all your debtors will pay you the amount that's outstanding. Some of those debtors are going to default or go bankrupt, and they won't pay the business. So that's what we're trying to explain here in terms of prudence. You might even talk about maybe accuracy in terms of maybe fair presentation. So you're not going to show the users the gross amount, you're showing the users the net amount, which is actually more accurate, and it's a better representation of what is actually going to happen based on past experience. Your estimate might be incorrect. It might be a bit high or a bit low depending on the scenario, but it's a general expectation in terms of trying to understate the current asset slightly to provide for a bad debt that may arise in the future. Because those assets are only assets if I'm going to actually receive the proceeds or the payments from those particular debtors. The debtors will have to pay the business. So that's what I would describe. Maybe prudence, maybe accuracy. Let's just set one concept here in terms of name one accounting concept which is being observed when a provision for doubtful debts is maintained. It's one mark. It's theory. I would probably go with either prudence or maybe accuracy in terms of fair representation. 3b, explain the difference between bad debts and a provision for doubtful debts. Okay, we've actually done this already. I'm glad I mentioned that earlier, so we can literally discuss it again, where I'm going to highlight what the differences are. Let's do it this way. Okay, great. So what is a provision for doubtful debts? It's a negative asset for disclosure purposes. Disclosure purposes. Okay, the reason why I say that is we spoke about it earlier. Not all your debtors are going to pay, so you're providing for a future bad debt that you're going to have to write off then, but you're creating it now to make the disclosure more accurate. So if we're talking about explaining what the difference is, a provision for doubtful debts would be, in terms of negative asset, it'll have a credit balance, okay, or you could view it viewed like a liability because of the credit balance. Okay, so it's the opposite of an asset. It's the opposite of debtors. You're providing for a provision. Bad debts or credit losses is an expense. Why? It meets the definition, outflow of benefit. Expenses are disclosed in the statement of comprehensive income. We can insert that. This would be disclosed as part of the statement of financial position. Okay, in a separate note for additional detail for the users. Bad debt would be an expense outflow. It'll be part of your statement of comprehensive income. It's a bad debt. It's operational expenses relating to writing off of bad debt. Explain the difference. So we have explained the difference. The one is a negative asset, the one's an expense. The one is disclosed here, the one is disclosed there. It's 2 marks. 3c. State 2 ways in which a firm may decide the amount of its provision for doubtful debt. So 2 ways. So we could look at an average from previous years. Okay, we could look at historical figures to get a percentage of the debtors that don't pay. Okay, that would be the most accurate measure, is to take historical information and using that as a basis to predict what you think the bad debts are going to be going forward. That's what you could use. They said state 2 ways. Another way could be using industry information or competitor information, using industry info or competitors info to predict the bad debts. Or when I say predict, it's not the right word, to estimate. No one can predict what's going to happen exactly. Estimate the bad debt / credit losses. Okay, maybe you could even use a portion. Okay, so it would be, again, it needs to be based on something. So I'm hesitant to say just use like 5% or 10%, because again, these are just numbers that are generally likely, okay, in terms of a certain percentage of your debtors not paying. But again, different businesses will have a different amount of debtors that don't pay. It's difficult to say if it's too high or too low. It's based on historical information generally. So you could use maybe a benchmark from previous info or previous years as a base, and you could then review that. The base could be adjusted higher or lower depending. So maybe last year was 5%, you might want to increase it by 6% because the economy is not doing very well. It all depends. It's difficult to say for certain how much the actual bad debt is going to be. It's quite a how can I say, it's like a specialized type of estimate that you're creating, because remember, it's based on historical information. You're creating these accounts, so it is an adjustment that needs to be provided for, which can be problematic in terms of trying to be as accurate as possible. Then we've got D. D is a theory question that has a working part of it. They've given you some information. This is actually quite a long question because they've given you a bit of info, and we're obviously going to have to provide for it in our solution. (3D) states, the following relates to the business of Mary Maranga, who writes up her accounts to 31st March each year. Then they give you trade receivables 1st of April 2015, 40%. They give trade receivables 31st March 2016, 46,000. Then they give you bad debts written off for the year ended 31st March 2016 as 800. Then they state, the provision for doubtful debts is maintained at 2.5% of the trade receivables at the end of each year. 1. Show the bad debts and the provision for doubtful debt accounts in Mary's ledger for the year ended 31st March 2016. Show the amount transferred to the income statement and the balance brought down on 1st April 2016. So they want a T account or two T accounts. How many T accounts? Yeah, 2. Then they say, number 2, part 2, show the relevant extract from Mary's statement of financial position. Okay, perfect. So it's disclosure as well as adjustments. So when looking at part 1, I'm required to draw up a T account. How many? Show the bad debts and the provision for doubtful debts accounts in Mary's ledger. Perfect. So we've got 2 to draw up. We've got the bad debts, and we've got the provision for doubtful debts. Provision for doubtful debts. Perfect. And then we need to look at the information in the question. So the question tells us that trade receivables 1 April 2015 is 40,000. They tell us that trade receivables 31st March 2016, 21st March 2016, 46,000. And they say bad debts written off for the year. For the year is 800. That's what they've given us in the question. They've stated that trade receivables 1st April 2015 and then 31st March 2016. Great. And then they say the provision for doubtful debts must be 2.5%. The 2.5%, yeah, it is 2.5% of the trade receivables. Trade receivables. That's what they've stated. So we need to record this in terms of bad debt and the provision for doubtful debts. They said we need to show the accounts for the year ended 31st of March 2016. Fine, so for that year end. Show the amount transferred to the income statement and balance brought down on the 1st of April 2016. Great, fine. So we need to start off with the actual provision. So they said that the provision is provided for 2.5%. So when we started with the 40,000, what would the provision be? Well, 40,000 times 0.25%. Okay, or 2.5%. 2.5% is 1,000. Let's just double check that. This times 2.5 divided by 100. Yeah, it's 1,000. Great. So when we look at the actual provision, we would have started the year with an existing provision of 1,000 that would have been provided for in the previous year. So I need to record that. On the 1st of April 2015, we would have had a balance brought down of a provision which was that 1,000. 2.5% of the balance that we had at the beginning of the year. Then we've got a balance here at the end of the year, which is 46,000. So again, I'm going to take this amount and I'm going to times it by 2.5%, and I'm going to get 1,150. So looking at that, we can see that this provision needs to go up. How do I make the provision bigger? I need to process the actual credit, and then I'll debit the bad debts. We also know that bad debts for the year was 800. So bad debt will be 800, and this would have been created during the year. So then we would have had the debtors. Did they ask for the debtors here? No, they didn't ask for the debtors. So that's interesting because there's two ways of doing this. You could write off bad debt to the provision, or you could write off bad debt to the debtors. So I'm going to show debtors as well here, trade receivables. And I'm going to show the debit and credit here. So bad debt, okay, you can write off to the trade receivables, writing it off. So then I would have, for the year, so I'll use the end of the year, 31st of March 2016, and I would have shown trade receivables here, general journal, writing off bad debt, and then I'll show bad debt here, 31st bad debts. But as I said, you could have written this straight off to the provision possibly, but I prefer keeping it separate because your bad debt affects your receivables. So if you're writing off bad debt, you're going to show that as a credit and that as the debit, 800 and 800. And then the provision, which is 1,150, needs to be created. So I'm going to create a new provision here, which will be 1st of April 2016, and the balance that you want to see there is 1,150, and then you would balance this account off because you'll have balance brought down and balance carried down. So 31st of the 3rd 16, balance carried down, and you would want to see that amount there. So the missing figure would then be an amount of 150, which is what you would provide for as bad debt as an adjustment. So you would have 31st of the 3rd 2016 bad debts, general journal. This would be an adjustment for the provision, which would then be 31st of the 3rd 16 provision for doubtful debts, and then I would show that increase over there. Okay, they said show the bad debts in the provision for doubtful debts in Mary's general ledger. We've shown that. For the year ended, show the amount transferred to the income statement and the balance brought down on 1st of April. So they do want us to show the closing off of this account. So we would then sum up those two amounts, which is 950, and 950 would be closed off to profit and loss. So I would show 950 there, 31st of the 3rd, 2016. Profit and loss. Great, so that's the profit and loss. That will be closed off from bad debts to the profit and loss for the year ended. What else did they want? Let's just read the question again. Balance brought down, have we shown that? Yes, we have. Number 2, show the relevant extract from Mary's statement of financial position. Perfect. Okay, so this is 3D2. Extract. Okay, we had that earlier. Let's get that. Where was it? Yeah, statement of financial position. Fine. Yeah, debtors. We need that. Alright, this is an extract of the statement of financial position. Under your current assets section, there will be not debtors. We can call this trade receivables just to use the same vocabulary. Trade receivables. Trade receivables, and that would be in the total minus the provision. So I would then be showing my total debtors, which I don't know. Did they give? Oh, I do know. They did give that to us. They gave us the opening balances here, so there are the balances. Did they ask for that account? No, they didn't. Okay, one was for 9 marks. They didn't ask for that tier account. But you could actually show that tier account here. I'm going to. Where's the balance? Let me take that balance here. Okay, I want to show the 4,000 there. I want to show this balance, which is the end of year balance. I want to show that here as well, just as additional. This is purely additional workings. Okay, the balance at the end of the year, which was that. We were told that in the question. Balance brought down and balance carried down. Brought down, carried down. Fine, we've got that. And then we would show this. And okay, we've written off bad debt there. We had a balance here. We're going to have to sum up this plus that equals that. And then you'd obviously have sales that would represent this minus that, which is 6,000. That would be sales for the year 31st of the 3rd, 2016, assuming that that was the sales. Okay, SJ as a balancing figure. But again, they didn't ask you for that. They just said show the extract. So the extract will be for the year ended, and they wanted 31st March 2016. So I'm going to need the balance. There's the balance at 31st March 2016. So I'm going to disclose that here. It's going to be 46,000 less the provision for the year, which was what? 1150 minus 1150, and subtract the bad debts that we wrote off during the year, which was 800. Okay, and that's what you would show as an extract. That was for 3 marks. Yeah, perfect. Okay, so 3D, extract of the statement of financial position, you'll show the closing balance. Okay, that amount, less the bad debts for the year, as well as this provision at the end of the year, because that's going to understate your bad debt, or your debtors rather. Okay, your debtors will be overstated because of the provision. Okay, the provision actually brings it down. And that's another question. This concludes question number 3 from the assignment number 3. Thank you for watching, and please consider subscribing to the channel. If you have any comments or questions, post them below, and consider liking the video, and we'll keep creating more to help you.